Thank you, George. I think a talk like that, however effectively delivered by Richard, on an empty stomach is a license for a riot here. So we will keep this within 30 minutes, I promise you. And there is a lunch, so you can control your stomach rumblings. And it will be a splendid lunch as the dinner was last night. Ladies and gentlemen, as a new honorary Limassolian, it's fantastic to see a gathering like this in our city. Which is absolutely at the heart of worldwide shipping, so it's fantastic. I'll just echo what's been said about that before. My name's Mark O'Neill. For those of you who don't know me, I'm President of Columbia Shipmanagement and the future CEO of the Columbia-Marlowe intended merger, which process, I'm glad to say, is going swimmingly and massively on course. And optimization, which is the theme of today, is at the heart of that process. The esteemed panel to my left, all of the names and addresses are well known to you. They're in the brochure, so we will save time in effecting introductions. The task of today is to talk about optimization of insurance and reinsurance. And as a lawyer, this is something that's right at the core of my interest as well. The present soft insurance and reinsurance market is probably the only silver lining in the present maritime industry's difficulties. And as business leaders, we obviously have to always look at rationalization, consolidation, and optimization. And this is the new word that's coming out today and in other forums. And this applies equally to insurance and reinsurance, absolutely crucial. That we look at our insurance and reinsurance provisions and see whether we can optimize them. But optimization is not just about cost, as I as a lawyer know very well. It's also about service, about robustness, and about reliability. We all know the adage, cheap and cheerful, but equally we know the adage, buy cheap, buy twice, and you pay what you get. So optimization is not just about cost. Also, bringing up the talk of Ben Nolan this morning, we can't consider this issue in the absence of geopolitical considerations either. Indeed, Martin Stopford's talk this morning, it's all dependent on what is going to be happening in the world going forward. Stating the obvious, world politics and the accepted political norms that we've all operated under have been turned on their head. First of all, we had Brexit. Now we have President Trump, and there is no prizes for getting that the flow of sanctions will be fast and furious going forward. So it's massively important that we pay attention to this particular area, insurance and reinsurance, where that market is primarily focused in the UK and indeed in the US. This will and unavoidably will and must affect shipping. And you've probably heard over the last few days there are new regulations coming out in the UK whereby there are new financial penalties imposed for breach of sanctions. So the UK is really stepping up its teeth in the sanction scenario. That's enough from me. We're going to have about 5 questions to each of these individuals on my left, and then we'll throw the floor open to questions from you guys, if of course there's appetite for questions as opposed to appetite for food. The first question to Ola, what do you understand about optimization against the background I've just given you, against that context? Is it cost or is it service?
Well, historically insurance has enjoyed a very important position in the operational environment of any ship owner or operator. But less so now, with adaptation to different and maybe more demanding financial environment, for ship owners, insurance is viewed as a requirement and more of a commodity. In addition to that, the underwriting community has not really been very innovative over the 350 years of the London market dominance. So we will need to twist this in a different angle. I think, as you all know, underwriting capacity is driven by the availability of cash. And cash into the insurance industry is a result of interest rate levels of alternative investments. So what I am suggesting is that one should look at intelligent insurance purchasing. And in addition to not only pay for insurance capacity and for the claim to be paid back to you, you should look for insurance providers that are able to provide you with additional services so that your loss is limited, not only your financial loss, but also your loss of time is limited. When the unfortunate event strikes, some underwriters will offer and apply their vast experience that they have gained under the handling of a number of cases, and you will benefit from that. So you should deal with a service provider and get all the value added, and then you can get paid by the capacity providers. So you should ask yourself the question, are you dealing with shipping people that do insurance? Or are you dealing with financial people that are selling a financial product?
Thank you, Ryan. That was comprehensive. Joseph, we've seen the American club diversify into Hull recently, and that's following the lead of others such as Guard, Swedish club. Is that part of the optimization process from a supplier's perspective that you see, or?
Well, I think there has been a great deal of diversification among the P&I clubs actually in recent years, as many who are sitting here will be very aware. The American club had an opportunity specifically to make an investment in a Solvency II accredited hull underwriter here in Cyprus, and I think in fact it is the first new Solvency II accredited hull insurer actually to be domiciled here. It began underwriting in the middle of July effectively as American Hellenic Hull Insurance Company Limited, as I say, the wholly owned subsidiary of the American club. I think that diversification is of benefit to the market, generally speaking. Clubs have done it in different ways, obviously. Clubs are, I would suggest, the suppliers par excellence within the marine insurance industry as a whole of additional added value services, not only just in the claims handling context, but also in the context of loss prevention, the provision of guarantees, the provision of undertakings in regard to international conventions, blue cards, and so on and so forth. And to that extent, I think they've enjoyed a strong position right from the get-go. And I think that it's a natural extension of providing the club ethos into the service dimension of hull and other products that, from the supplier's point of view, yes, has certain advantages, but I think actually ultimately, as the industry as a whole necessarily will drive things in response to what ship owners and ship operators really want from their insurance providers, hull, P&I, etc.
Thank you. Stephen, when do you see the market bottoming out, and when will that be, and how do we best prepare for it?
Friday at 2 o'clock. Actually, we would like to point out the divergence that exists between premium trends, and here we're most active in the management liability. The market will change on Friday at 2 o'clock if you missed that. Okay. We'd like to point out the divergence that exists between premium trends and the factors which drive losses. I'll ask you to consider why this divergence cannot be sustained and how business owners and managers can respond. And here we return to our theme of optimization. What steps can be taken now as we anticipate more challenging markets? And I'd like to share some of those steps with you. Number one, view the relationship with your D&O carrier and all your carriers truly as partnerships. As we approach a change in the market, resist changing partners, especially when the pricing advantages are modest and the prospective carrier is untested in difficult markets. Policy forms have changed, they've improved. If you're using the same form that you've been using for years, ask your broker. And if your endorsements are more lengthy than your policies, that's usually a good sign that someone's done their homework. Make a list of the jurisdictions in which you trade, where you have property, where you have employees or subsidiaries. Take a look at your primary coverage and whether your carrier is admitted in those jurisdictions. If they're not, inquire about a local policy and stack your master global program on top of a local one. Soft market is a good time to review your limits. If your capitalization is diminished, consider whether your limit is still appropriate, but keep in mind that it is easier to decrease than increase. With the growth of regulatory inquiries, which Richard spoke about, see if preparing a response is a covered claim under your management liability policy. Preparing to defend against an enforcement action is very, very costly. If you don't enjoy reading your policies, and that probably covers most of us, at least review the exclusions. Discuss these with your broker. They're harder to remove once the market turns, but not all exclusions are bad. Be judicious about adding additional covered persons to your management liability policy, and at times the fraud exclusions do make sense. Remember, eliminating these can result in eroded limits for your key people. And last, when you renew, give thought as to who will complete the application. Remember, the fewer representations, the better. So in sum, the metrics and factors describing claims incidents seem detached from premium trends. Buyers, we've all been benefiting from an influx of capital into the D&O markets. As interest rates return to more normative levels, a reduction in new capital may lead to a firming in rates. History tends to repeat itself. We don't know exactly when, but rarely are they warnings. And that's how we optimize.
Thanks, Steve. I think what you're saying there is go through your existing cover and stress test that and see whether it's robust enough and whether it's worth changing in those circumstances.
Exactly.
Costas, you've had a great success in offering proactive advice to your clients, both in relation to potential fixing and also in relation to the concept of captives. And perhaps you'd like to tell us a bit about both of those.
Yes, thank you, Mark. Well, when I had the subject to elaborate on, I was thinking, what do I say today? And the word optimization is a word that is flowing around in every organization, in every aspect of an organization, but you can only optimize within the sphere of things that you know or you can lay hand on. So you cannot optimize on elements that are probably beyond what you are able to see. And the concept of a captive company, which is a purpose-built vehicle that would allow its parent company, that is the shipowning company, to insure the ships with its own insurance company, and then the insurance company can have access to the reinsurance market. And that aspect is what you probably, the majority, don't see. You see the conventional market, which is functioning the way we all know, and is being represented today with first-class individuals representing first-class companies. But what we are probably trying to allude at is that there is a whole world that you do not have currently access to, and that is the reinsurance market. Creating a captive company, you are creating another management tool which will give you alternative options as regards insurance. Such an insurance company can have access to excess of loss insurances, stop loss insurances, and whilst today a fleet of 20 ships will have 20 different policies for the full sum insured of each vessel, and you are paying for individual ships for the relevant premium that your brokers are negotiating for you. Accessibility to the reinsurance market can provide you with excess of loss insurances and stop loss insurances, which means that you can insure ships not on an individual basis but in bulk, having floating limits, deciding what would be your retention in conjunction with what is the cost that you are trying to achieve, and effectively optimize with insurance instruments that are not readily available in the direct market. There are multiple benefits to that. Cost is one, of course, but you can also be part of a contract which provides some additional benefits that are being provided to the insurance companies that you know, because they will obviously have their own insurance arrangements. So if the volume permits, there is a great likelihood that one should be investigating the captive concept and identifying, based on performance related indicators, whether this would be a viable option for your company.
And Costas, how quickly can that be set up, such a capital? Is it a long-term project, or is it it can be set up quite quickly?
Now, if I take one jurisdiction that I do have in mind, which is the Bermudas, within 2 to 3 months, everything could be set up, managed, and get ready to underwrite on behalf of its parent.
And the second part of the question, Costas, was fixed rates. How possible is that? How easy is that? And is there then a possibility to break out of those rates if the market continues to soften, for instance, and you want to benefit from that softening? Or if indeed, if it hardens, how easy is it to hold on to those fixed rates?
Well, it's, as you say in your language, market's a catch-22. We try to preach that today we are looking at rock bottom. We may be, after all, be proven to be at fault. So if you engage into a long-term program today, which it does look that it will be beneficial for our clients, in a year's time, if things don't change and the trend continues, our clients will be looking for further flexibility on the rates, and you would bar them from being able to negotiate if you fix on more than the casual 12 months policy. So there are available fixed contracts, but those go to a maximum of 12 plus 12 months. Unfortunately, as much as the underwriting world would like to secure their business as well, they are uncertain as to their own reinsurance arrangements, and therefore there are prohibiting factors for a mutual agreement on long-term contracts beyond, let's say, 2 years.
Thank you, Costas. This is a final question from me. It might take over the debate somewhat, but it's something that keeps me awake at night in my new role, and certainly kept my clients awake at night in my previous role. It is possible for a vessel to be registered in a jurisdiction which is totally exempt from US or European or UN sanctions, and it is possible for that vessel to be chartered to a charterer for business that is also in compliance with sanctions. However, that entire project will fall foul of the fact that the insurance or reinsurance is placed in the US or the UK, and that location of the reinsurance prevents the vessel from otherwise performing what is a legitimate trade, performing it in compliance with its employment obligations. Now, not only could that lead to criminal and civil liability, but it also could lead to contractual liability for the owner, the operator, to its contractual counterpart, the charterer, because the charterer has said, this is a legitimate trade, a legitimate vessel, and you, the owner, haven't sorted out your insurance affairs as you are expected to do, and therefore you're in breach. Now, I haven't heard anywhere from any insurer ever a satisfactory answer to that problem, and it's a problem that's going to get more and more for us as President Trump settles into his job and becomes more comfortable with executive orders. So perhaps, Ole, could you start off? How are you, as a Norwegian Hull Club, looking into this, and how will you best protect your assureds from just this sort of situation? Is there a solution?
It's very difficult to know because the case hasn't really been tested yet. Norwegian Hull Club does have US reinsurers, but that is in in fact not really of concern to the assured, unless there is an indication in policy saying that, referring to what the reinsurers may do or may not do. I mean, we are generally following the market rules, which is subject to the relevant sanction clause. Now, that doesn't answer your question. Your question is, will you pay or not? And I think maybe the problem is not the insurance world as much as it is the banking world, where there are very much limitations on the exchanges of currencies and the payments that are made for guarantees and so forth in whatever jurisdiction there is a sanction against.
There are issues, obviously, on the banking world and the location of the clearing banks, but specifically we've all had situations where vessels have been on the way in apparently legitimate trade to be told that actually if you continue with that trade you will not be covered. And I just can't find an answer to that question, which is going to become ever more important to us going forward.
I think that
Is it a case of relocating some or part of the reinsurance market, or is that possible, or is that naive, or are there other solutions?
Well, as I said, I don't think there is a reinsurance problem with a direct insurer problem more than a reinsurance problem. However, of course, what the reinsurers will do will have an impact on what the direct insurers will do. So there is a what comes first situation here. But I think in general, underwriters are quite flexible, I would say, for the time being. I mean, there are ways you can get around it, but there is no waterproof solution to it.
Thank you. Costas, would you like to throw in your 4 pennies worth?
Yes, although you know I work for a US company, so I have to be very careful what to say. But in general, I agree with Ule, and what I could suggest, because discussions have been ongoing on this particular subject, and we reached a stage with some of our clients that wanted to press this button to say, well, good old partners of ours on the insurance side, we would like to have disclosure of your insurance arrangements so that we can identify what is our financial exposure. And this is a natural question to be raised, because as every organization is assessing its risk management strategy, for any venture to progress in terms of chartering the ship out or any trade that would involve this scenario, they would like to know, against the earnings that they will have, what would be the likely exposure of something going wrong and not being able to recover from insurance. So we would probably force for disclosure of exactly what this exposure is.
So as part of any operator's normal sanctions checks, in accordance with their sanctions policies, it is advisable to pass your intended trades through your insurers to just get their view and get their blessing that there's not going to be an insurance or reinsurance aspect. Effectively, what you're saying too.
Correct. Plus, what is the actual exposure in terms of percentage of the risk? You insure 100% for your P&I, your hull machinery, your war, your IV. You want to know exactly what percentage could have an impact from the reinsurance arrangements of your insurers. So it's not an easy thing to implement, but it's also only natural for our clients to ask, especially these days that obviously the income is marginal or negative. So they need to know that transacting or concluding an agreement, they want to know what the residual risks are that they are taking. And unfortunately, at this moment in time, there is an unfair contract term into the insurance policies, which you have clearly described, which is an unidentified element which nobody knows unless we are privy of the reinsurance arrangements of our insurers.
Joseph, have you got any comments on that?
Well, yes. I mean, obviously, the issue of US sanctions has been a concern for a while, actually, within the shipping industry and within the banking sector also. What President Trump is likely to do, I think, remains imponderable. So far as existing sanctions are concerned, I mean, you will be aware of the fact that recently both Burma, as it's commonly referred to by Myanmar, came off the sanctions list, and more recently Sudan. the issues really concern Iranian and Syrian trade, and to a more limited extent, obviously in the US context, Cuba. One other thing actually that ought to be borne in mind, because it was relevant to the renewal of the International Group's Reinsurance for 2017, is that at the time of the JCPOA agreement back in January of 2016, that's a joint comprehensive plan of action that was undertaken by P5+1 in relation to the agreement reached with Iran on the proliferation issue. OFAC issued what we name General License H, which effectively permitted US subsidiaries to provide services of various kinds that would otherwise be prohibited by US domiciled companies in certain circumstances. And the international group's RI for 2017 takes benefit of that, and the US underwriters who were previously engaged on that contract for the renewing year, that capacity has been taken up in effect by those subsidiaries of US reinsurers under the allowances of General License H. OFAC is amenable to licensing. Of course, it tends to act relatively slowly when inquiries of this kind are made, but I would suggest that, and one can't say with any degree of certainty obviously what will emerge in the future, but I would suggest that some of the concerns in regard to the position of OFAC and of the US government generally may be a case of greater concern than may truly be justified in individual cases.
Thank you, Steve. Very quickly.
Just quickly, it comes back to my point that I made earlier in the management liability area of looking at where your policy, the situs of your various policies, the need for complementary local and master programs, and also for optimization. It's a good time to take a look at what the renewability conditions are, whether they are optional or conditional, particularly when it comes to sanctions.
I think from a legal perspective, the position is that as far as your insurance and reinsurance is concerned, we are all subject to US sanctions, wherever you trade and wherever the trade is. So to look at the type of trade or to look at the owning structure or the chartering structure, US sanctions do apply. And I think taking up what Stephen said, when you go into a particular trade, you really do need to assess the risk and the appetite for the risk for that trade, knowing that some of your cover, as Costas said, a percentage of your cover might not be there, and you might perceive it to be there, but it won't be. So I personally, in the new role, would like to see the insurance industry trying to tackle this and affording an answer. I don't think there is an answer at the moment, in fairness to the panel to my left. But we have lived with the sanctions for a number of years now, and I think it's timely that something is brought forward. That's all that we've got from the questions side. I'm conscious that we want to throw it over to you for some questions that you might have. If you can just delay before lunch, but George, that's all from us for the moment.
Yes, thank you. I just want to can I ask one question, if I may? On the sanction issue, of course, I think it's a whole can of worms. In fact, it goes back for half a century, if you want to think about it, with the situation which we were involved with, Greek friends of mine, with the embargo in Cuba. And so what we're facing here is a bit of an hors d'oeuvre in relation to what we had then. But my question is on the captive insurance policies, because I happen to be a Lloyd's underwriter for a number of years. I think that was also a grey area, because sometimes you get companies who carry out an insurance policy, they use a captive, then save a tremendous amount of premium. They probably pay near to nothing in their insurance policies. But then on the other hand, it goes on to the reinsurance scheme, and that's a situation where we never really get to the end of it, what the real costing effective is. That's what I want to know. I mean, the Concordia loan, for example, has cost the market, the reinsurance market, over $2.5 billion. I repeat, $2.5 billion, and I didn't hear anybody blink an eyelid. Thank you.
Ladies and gentlemen, thanks to my panel on the left. Really useful comments there. Any questions before we break for lunch? That's what lunch does for you, the incentive of lunch. Great, fantastic. Thank you very much.